This is ENN, the Equitable News Network, business television for the premier life insurance company.
I think we're here today at the beginning of a new era for the Equitable. During the last 25 years, the industry, and with the Equitable as a leader, has seen a major conversion from traditional fixed dollar products to equity-based variable annuities and variable life insurance. It has paralleled a tremendous growth of mutual funds in all forms of retirement planning, from IRA, KEOs, and 401k plans. Investors are more aware of investment choices, but the growth of these tremendous retirement assets has created an opportunity for us to capitalize on. Because for the next 25 years, there's going to be a major shift from the accumulation of assets to the distribution of assets. Those will be distributed to the investor during the investor's lifetime, to the spouse in the form of a survivor benefit, to the kids or grandkids in the form of an inheritance, to caregivers and medical professionals in case there's disability, and to various tax authorities. It is this shift from accumulation to distribution which is the basis of the income manager group. The Equitable each year does a study called the Nest Egg Study. And one of the things that came out of the most recent study is that the major concern of retirees is outliving their retirement assets. Now, a lot of things can impact that, whether their assets are going to be adequate. They want to have money for the surviving spouse. They'd love to leave money to the kids and grandkids. They'd like to have money in case they can't take care of themselves after retirement. Inflation erodes the value of their retirement assets. And investment loss also is a concern of retirees. The one concern that a lot of people don't do anything about is the risk of living too long. And that's a risk that the insurance industry can shift from the individual to the retiree. Now, the market for this particular product, this shift from accumulation to distribution, is large today, but it's going to get even larger in the future. This chart shows that 2 million new retirees, that's people age 62, will enter the retirement world in 1995. By the year 2010, the number will nearly double to close to 4 million. So we're talking about a market in sheer numbers of people that's going to double over the next 15 years. Now, what is the problem that most retirees face? This is an example of an individual who this is beyond the assets they have in their corporate pension, beyond the assets they've set aside in a qualified plan. They've done a good job. They scrimped, they saved, and they have $250,000 at retirement. However, they're trying to do something that they're ill-prepared to do, which is to manage this $250,000 over their future lifetime. And so they do what a lot of people do, which is say that I will never touch principal, I'll live off savings, and I'll invest very conservatively. In this particular example, today we assume that they can earn 6% without the risk to their principal. So they're earning today $15,000, and their plan by default is to leave the $250,000 of principal to the children. Sounds like a pretty good plan today. However, if we just introduce modest inflation of 3% a year, in 25 years, the purchasing power of that $15,000 is down to close to $7,400, or it's been cut in half. The amount in terms of purchasing power that will be left to the children or the grandchildren likewise has been cut in half. The individual is not happy with this result, but let's look at what their various alternatives are. One example, they could delay retirement or go back into the workforce. I don't think people scrimped and saved to look forward to going back to work. As one of our members of our focus groups have said, once you're off the train, you don't want to get back on, and you can't get back on in a lot of cases. So we don't think that's necessarily a viable alternative. Another choice is to disinherit the children. Now, some studies show that an older generation probably those who were around in the Depression, want to leave their children with a major legacy. There's a little younger group, 10 to 15 years younger, who may in fact say that the kids, we put them through college, and that these assets are designed for our retirement, not for our children's retirement. But again, that's a decision that each individual will have to make. The couple, in this case, could lower their standard of living. They could basically lower their standard of living so that the $15,000 now reduced to $7,400 will work for them. They could take more investment risk, but then they have the potential of an investment loss, which might reduce the income even further. Or they could take the risk that they are taking by inaction, the longevity risk. That is, we're going to spend our money, we're not going to lower our standard of living, and hopefully we'll run out before our assets run out. Let's look at that particular strategy. This is a couple that decides that, and these are, for this purpose, they're a couple, both age 65, who've decided to spend $15,000 in purchasing power, so they have to eat into their principal. And that's a pretty good strategy for about 20 to 22 years, but sometime between the 20th and the 25th year, they run out of money. They ate into all of their principal, and by the year 25, they have no principal and they have no income. Now, I showed this chart to some very sophisticated people, and they said, well, that's going to affect a relatively small percentage of the population, so that may be a viable strategy. Well, here's a chart of a couple at retirement showing the probability of their surviving, that is, one or both surviving. We asked the question, at what age is there a probability that 50% of them will still be around? Well, interesting enough, it's age 90. So in the prior example, we're talking about 50% of the couples or more would run out of money if they adopted the strategy of taking $15,000 of purchasing power and taking the longevity risk. Well, that's what we do. We're as an industry and as a company, we take risks. That is the risk of dying prematurely, that's life insurance, the risk of becoming disabled, that's disability insurance, and the longevity risk, that's what you know as an immediate annuity.